Welcome everybody. Welcome to your Mastermind Monday. This is October, and today we are going to be talking about money. So, Masterclass Monday, we're talking about money. This is M Day apparently, and but not completely M Day, because our terrific guests today are very own circle partners from Wells Fargo. So they're going to be talking about capital stacking and different ways to get funding into your business. And I'm not going to spend any more time talking myself because I want them to have as much time as possible. So Val Jones, I'm going to pass to you.
Yeah, thanks, Linda. So nice to see many familiar faces here. So I think this is going to be a really interesting conversation. I will encourage you to ask us questions. So we'll do a little bit of talking here and share some ideas and thoughts with you. But I think really the most valuable opportunity here is just to talk with us. So who are we? So I'm Val Jones. I've been working with NAWBO now for a very long time, and I love it. I currently work in our merchant services area, and I help us build stronger partnerships with our banker partners. So that's kind of a new role for me. So I'm learning a new line of business, and it's exciting. But I brought the experts back with me. So you probably have a familiar face here, Manoush Asghari. So Manoush is our site leader here in Charlotte, North Carolina, and she manages the entire Eastern team. She has relationship managers that work with our larger, more complex businesses, and she also has now taken on our small business bankers who work with startups and smaller businesses. So she has a very large span. Her team serves customers from zero in revenue all the way up to 25 million in revenue, and she has a very strong background in commercial banking and has an accounting degree and really knows her finances. And you've probably seen her at conference. So she's back. I brought her with me, and I brought a new friend with me, Luisa Martino. Luisa is on Manoush's team, and Luisa actually manages those fantastic small business bankers who serve our customers from zero to about $1 to $2 million, depends on what their needs are. So I brought the experts with me, and we're just going to dig right into this conversation. When I was talking with Linda, she said, capital stack is always a hot topic. There's lots of different financing sources available out there. Clearly, we're the bank experts, so we're here to talk about bank credit. But because Luisa and Manoush have that strong background, we can talk about other sources of financing. And we want to help you think about, out of all the different sources that are out there, which ones are right for me for this particular need that I have? And do those needs change over time? How can I adjust that? So that's pretty much where we're going to land with this. We want to demystify bank credit. I know sometimes it feels like, man, I apply and I applied for 50,000 and you gave me 10,000. How is that going to help me? I don't understand that. Or maybe I applied and I got declined. I don't understand that either. My credit's fantastic. So there's lots of reasons why credit can get kind of mysterious on the small business side and larger business side. So again, I brought the experts with me here. And then we're going to talk about different capital stacks strategies. So you're already a circle member, so that tells me that you're already pretty familiar with these topics and that you've had success getting your business up to this point. So we're not going to start at the very beginning with this conversation. So there's lots of pros and cons to the different sources of capital that are available to you, as you know, and so that's really what we wanted to dig in with. So I'm actually going to start with you, Luisa. Okay, so Luisa, can you give us just a really broad overview of bank credit options available for established businesses? And think about like when and why would businesses use bank credit and over other sources of capital? Out of everything that's out there, when is bank credit? So tell us.
Awesome. Thank you. And thank you for having me on this panel today. So there's actually 6 that come to mind when it comes to traditional bank credit options for established businesses. But before I get into all the details of these 6 options, I want you all to know that we don't expect you to know them all or remember them all or determine which one is best for your situation. That's where our bankers come in. Their job is to learn about your business, understand your goals, and help match you with the right solutions. But with that, here are the 6 options. So we have term loans. Those are good for long-term investments like equipment or maybe some expansion. We have things like lines of credit, which are flexible funds for short-term needs, right? They kind of help you meet the ends, in between. There's commercial real estate loans, and those are really good for buying and refinancing property. There's equipment financing. Those are good for equipment, exactly in the title. There's SBA loans, which are government backed and they usually have some favorable terms. And then there's the business credit card, which you all, I'm sure, are really familiar with credit cards, but there's also the business options for the credit card. And to answer the second part of your question, why choose bank credit over other capital sources? I would say that for one, it's lower cost, so typically better rates than private lenders. There's no ownership dilution, unlike equity financing where you raise money by selling shares of your business to investors. In these options, you wouldn't. Predictable repayment, right, which helps you with cash flow planning. And then strong relationships. It's really critical to build strong relationship with the bank. So this allows you to start building that as your business grows. So in closing, I would say that overall, bank credit gives you established business, affordable, reliable capital while keeping control in your hands. Thanks, Val.
Awesome. Thanks, Louise. Awesome. Manoush?
Hello, everyone. It's good to see you all. And thank you for having us today. Louisa actually went over the products in terms of the options, but I just want to put a little bit more emphasis. The fact is, and I'm sure you all have seen the Wells Fargo advertising. You know how to run your business. We know how to do the business banking. And that apply for, I'm hoping for all of the banks, that you need to rely on your banker to give you the right advice. So the products, there's so many different products at the bank, and each bank is actually have their own products offering. What we expect from you to go tell your story and your vision for your business, what you're trying to accomplish, and let your banker give you the right recommendations, what's best for your business. So just keep that in mind. Yes, of course, we want you to know about the products, but in terms of the matching, what is, just like Louisa said, what's the best product? Let your bankers to come up with that recommendations. Just, I always said in many different conferences, your best friends should be your CPA, attorney, and your banker. Let them work for you, behalf of you, to be your best partners to grow your business. Running the business, it's a lot. You need to have a lot of resources and experts to help you. So I'm just gonna end with that, Val, for this part. I have nothing else to add what Louisa said. I just want to make sure they have a best friends at whoever the bank they're banking with in terms of helping them with the products offering.
Awesome. Thanks, Manoush. And I'll actually stick with you here. So I mentioned we would talk about demystifying the credit worthiness piece. So how do banks like Wells Fargo assess credit worthiness for businesses? And then kind of in line with that, how do we assign credit limits?
Yeah. So what I'm about to say, it's not foreign to any of you. You're all familiar with 5 C's of credit. But I'm just going to actually talk about it. What does that mean? And then you can think about it. Okay, if I want to go to borrow money from a lender, what do I need to focus on? And what do I need to tell the lender? First one is the character. What does that mean? Character, it's the owner. It's you. And we take a look at the credit history and reputation. And when we say credit history, this is not limited to the business credit history. It's actually a personal credit history. A lot of times the customers ask us, do I need to guarantee this credit? And I'm just asking them, do you believe your business? Yeah, what is that to do with my guarantee? If you believe in your business, then you need to guarantee it, because if you're telling me you don't want to do the personal guarantee, how do you expect me to believe in your vision and your business? So that's why we take a look at your personal credit history and see how you handle your personal credit. That's not only limited to your home mortgage or your auto loan, it's also your credit card or any home equity line, any of that. That is the indicator. How would you actually handle a business credit card, business line of credit, business loan? Because in reality, end of the day, the business is you. Without you, there is no business. So that's why the character going to play the big factors in terms of the credit history and how we are lending money. The other one is the capacity. Capacity is a cash flow. So it depends of the situation. It depends if it's a startup. It depends of the what's the stage of the business. Is established business. Let's just say for the audience we have today is established business. What we look is, okay, if I lend you $100,000, $200,000, your business cash flow, can you repay that debt or not? And we have a calculation to make. You say per dollar you're borrowing from us, we want to see $1.25 to $1.35 back. And when we take a look at it, it's not only limited to the business cash flow, we also have a global cash flow. What does that mean? That means it's on the business and also on the personal. We combine it and it's going to be a global. So I give you an example. We sometimes have the customers and they, let's just say, have a sufficient business coverage on the cash flow. But then you take a look at the personal, they take a lot of money from the company and we don't see it on the personal side. When I say we don't see it on the personal side, that's mean, okay, did you invest on a personal side to grow your own personal wealth or not? Or sometimes I tease or joke around, so say, oh, these customers would like have a lot of nice toys. So if you're investing in a lot of nice toys, that means it's just the business gonna struggle and the business gonna actually have a lot of challenges because there is not much of the equity back to the business. So that's why we say business fund flow and global cash flow. That's mean personal and the business. The other one is the capital. Again, that goes to the net worth and the financial strength of the personal and the business. The other C is the collateral. What kind of assets we have to secure any type of a credit. Just like Louisa said, when she was going over the type of a products, if you are buying a real estate, that real estate is our collateral. What is the quality of that? If you're coming and borrow money for the growth of between, for the business in terms of the filling the gap between account payable and receivable, okay, what is the quality of the receivable? What's the quality of the inventory? What's the quality of the fixed assets? So that is considered as a collateral for us. And the last one is the condition. What is the condition? Economic and industry factors. What is happening today? What is a lot of uncertainty for the businesses? Tariff, inflation. A lot of our customers are worried about their suppliers, especially if it comes from certain countries. I have a client, their supplies is not there yet because it's actually not been released until they want to know about more of what is the tariff and what is the policy about it. And that's why we always say, do not just put all of your eggs in one basket with your suppliers. Make sure you have a diversifications. And what's happening with the economy? Which industry is a more risk and which industry it's at the high risk because of what's happening at the moment. We all learned a lot from the pandemic. And that's why a lot of business owners, they need to have that type of a perspectives and creativity. How else I'm going to do business? how I'm going to pivot quickly when things change. And this is helping us to make decisions when we are lending money. We evaluate all of it. It's not only about, oh, do you have cash flow or not? Every one of those C's will we do the write up and we make a decisions based on every one of those C's. That's about in terms of the how we make a decisions for credit and credit limit, Val.
Awesome. Let me get myself off of mute there. I love how you walked us through the 5 C's of credit. The other thing I want to just add to what you had to say is sometimes I've heard business owners express frustration. They're like, look, I was able to easily on the personal side get this loan, or I got this credit card with this huge credit line. Why is it so small for my business? I don't understand. I'm still me. My credit's amazing. I've got this great credit history. It's because of the risk. Right? So it's like, if you think about your personal life, you're going to pay your mortgage, you're going to pay your car payment, you got to get around. But if push comes to shove and things are tight, you're probably less likely to pay the business loan, or you're more likely to let that one go a little bit later than you would on the personal side. So just keep that in mind. Even if your credit is stellar and on the personal side, they just can't give you the money fast enough. It still is a little bit different on the business side, because like Manoush was saying, there's just a lot of factors to balance out there. And when you introduce a business, it introduces a new kind of risk. Could be that your industry is high risk. There's a lot of different factors that come into play there. So it's not apples to apples. Your great personal credit history is always going to help you on the business side, but it's not, as to Manoush's point, that's not the only thing that we're looking at. It's the big picture. Awesome. Okay, let's move along and talk about some non-bank options that you've seen clients use out there. And Luis, I'm going to actually go back to you for this one. So as you think about the kind of clients that you're working with, what are some sources that you see them using in addition to bank credit? And then as you think that through, what are some advantages and disadvantages as you see it for those other sources?
Thanks, Val. I love this question because it highlights how creative business owners can be when it comes to funding. So in addition to bank credit, I often see clients using a mix of other sources. So for one, self-funding, right? Which means using your own personal savings or assets. An advantage of that is you have full control, and at the end of the day, you have no debt. The disadvantage would be high personal risk and limited capacity, right? You only have so much of it. The option 2 would be investors, like angel investors or venture capital. Advantages would be access to larger capital and strategic support. The disadvantage would be ownership delusion and potential loss of control, right? Number 3 would be private credit, such as online lenders or fintech platforms. Again, the advantage would be it's a faster approval and they may have more flexible terms, where the disadvantage would be higher interest rates and maybe less regulations on those. Number 4 would be revenue-based financing, where repayment is tied to your monthly revenue. Advantages would be flexible payments that adjust with performance. Disadvantage would be it can be expensive and a little bit unpredictable. I would also add CDFIs, which are community development financial institutions. Some of those advantages would be it's mission driven, often more willing to work with underserved businesses. The disadvantage would be smaller loan sizes and longer approval. It takes a little bit of time to get those. And then last but not least would be grants from government or nonprofit sources. The advantage is free money, no repayment. And then the disadvantage would be highly competitive and time consuming to apply. I would say that each option has its place depending on your business stage, your goals, and your risk tolerance. The key is making sure you, the business owner, understand the trade-offs so that you can make an informed decision. Thanks, Val.
Awesome.
Back to you.
Awesome. Thanks for walking us through some of those options. And I've definitely seeing the pros and cons of seeing business owners use different ones. I usually, if I'm at a conference, people are coming up to me just wanting grants, just grants. Give me the grants. I want the free money. I don't want to owe anybody money. I don't want to give up ownership. They are wonderful, but it's like a bonus. It really is like a bonus. I wouldn't have a business plan focused on grant money. It's nice if you can get it, but some of these other sources are ones that can work in harmony with bank credit. They're not necessarily at odds with each other. Sometimes I hear CDFIs, for example. Are we competitors? We're actually not. Banks give money to CDFIs. We have really strong partnerships with CDFIs in the community, and we fulfill kind of slightly different needs in the marketplace. And ideally, if you're someone that isn't quite ready for bank credit, CDFIs can often fill that gap during that time. And the nice thing about CDFIs is that they'll actually work really, really closely with you to get you to bank credit. That's really their goal. Is like, let's get you the best terms, the best financing that we can. Bank credit is typically going to be the best interest rates, the best, terms all around. So just giving a couple examples out there. And so then Manoush, tell us a little bit about what you see in practice. What are some different types of capital stack strategies that you see out there, mixing those different funding sources? How have you seen that work effectively for businesses?
Val, it's all situational. Every business is unique, and their needs and their financing is also unique. So it doesn't mean one size fit all. I just want to make sure everyone understand that. And that's why having a good CPA, banker, and attorney gonna be very crucial to help to select the right options and choices for the businesses. Like nowadays, with AI is available, it's just going to make it easier to do the research. Okay, so let's just take advantage of that. Any of you on this call are kind of a hesitant to say, "Oh, I don't know about that. I don't know about the AI. I don't know about, doing those researchers. Is it reliable or not?" Embrace it. Embrace it and leverage it to your advantage to see what's best. Then at least when you go talk to your CPA and your attorney or your banker, you do have already some information. Then you can verify that with them. Then that way you're going to make a better decisions in terms of what's best for your business. And sometimes some of those combinations is just you never heard about it. When we're talking about those hybrid capital strategies, it can be a SBA loan plus equity investment. It can be just like Louisa was talking about, revenue-based financing plus crowdfunding. It can be fintech plus grant. Or sometimes in the traditional banks, they offer some products, it's never been available before. So I give you some examples. Right now, even though the traditional banks are more innovative and they are thinking about how they can help their customers on the digital space, how they can serve their customers with the products is faster, and it's the access to it, it's much easier than before. Yeah, of course, when it's a higher risk for the bank, it's going to be a higher interest rate, that's for sure. Or right now, a lot of banks are just saying, okay, I don't need that many documentations for this certain amount of line of credit. But again, then it's a higher risk for that. And is a higher risk is a higher interest. It depends where you are in your business, what you want. That's why it's so crucial to have the right team to help you to select those. But uh, as I said, uh, I'm going to put a lot of emphasis. Please do a lot of research and talk to your BFFs. Remember, the CPA, the bankers, and your attorney to land with the right decision. Because every businesses now trying to come with the next level in terms of their product offering, the growth, and it's the same thing. The banks and other financial institutions, they're also thinking how they can become more innovative to serve their customers too. So I I hope that answered your question, Val, because I want to make sure they don't think it's a one type or one solutions to help their business.
Yeah, I think you made some really great points too. It depends on how young or established your business is. It depends on the use of the funds. What am I, what am I need to use the funds for? Is it ongoing? Is it just one time? What's going to be the most cost effective? What's going to help me out on my taxes? So to Manusha's point, have your team. I've heard it referred to as the bail team. I'm sure some of you have heard that too. So banker, accountant, insurance agent, lawyer. Get your bail team together. Ideally, they're talking to each other. So your accountant is helping you on the tax side, but not so much that it's going to hurt you when you're asking for credit. Your banker is going to help you with, so just make sure you have like your board of directors talking to each other. I wanted to get a little bit more to real world scenarios. So, and I will be opening it up to the group. So if you have scenarios, things you want to talk about, we are excited to talk to you about it. But just really briefly, I wanted to think about different scenarios where businesses really need to have capital. Expansion comes to mind first. That's exciting time. I want to grow my business. What are the likely sources of capital? What are the bank credit options that would be most beneficial? And Manusha, I'll start with you, but Louisa, feel free to chime in as well. So expansion, what would you recommend?
Okay. Again, this is just going to be depend of what kind of expansion we are talking about. Are you talking about buying the equipment? Are you talking about introducing a new product? Are you talking about adding more staff and you want to hire more salespeople to offer more of your products and be able to sell your products? It's all depend. And every situation can be have a different choice and options in terms of to selecting from it. So let's just say if you're expanding your business because you want to add a new product. Okay. My number one recommendation is always go ask for credit when you don't need it. That might sound, it's going to be funny to you all. Why would I do that? Because to me, when you need it, that's mean you already used every penny of your cash in the bank with your business. And that's why you just say, okay, I already spent all of my own money. Bank, can you help me now? Remember, we talked about it on those 5 C's. The bank also want to see your business is still healthy and can repay the debt. So if you already spent every single penny of your money, the likelihood for the bank is also going to be able to lend you what you ask for. It's not going to be favorable. So make sure if you have a business expansion ideas, if you are trying to hire more people, have these conversations with your bankers or with your CPA early on, not after the fact. Do not go ask them after the fact. And this is going to help you to put you in the right situation and with the right product and services. To answer Val's questions when she said, okay, I'm expanding my business. What options do I have? Okay. Are you buying the real estate? Is that the expansion? Then you do have a SBA options, and you also can have a conventional loan for your real estate. When you say expansions, you're hiring more employees. Okay, that's line of credit. But how much do you need? Do you know how much do you need? How many employees you're hiring? What is their average salary? So, or the next question comes to my mind, if I'm a lender, I'm going to say, okay, so you want to hire 5 more employees, their average salary is $40,000. As a result of hiring those employees, what would be the projected revenue for your business? Make sure you have the entire story of what you're going to do with the money and what is your plan before you go borrow money. Then the bankers actually can give you the right product with the right services or the reason. We call it borrowing costs. So the borrowing costs, so they can match it with your borrowing costs. But we talked about all of those different options, Val, in terms of like Louisa went even over all of the list of it too. So the good thing is because of the fintech, the AI and all of that, we have so many different options. And with the bank, it's also they have different product and services too. So the borrowing cost is important. Go borrow money before you need it, not after the fact, and make sure you know what you're going to do with the money and what is the impact of that, how it's going to help with your business grow, and what would be the projected revenue.
So it sounds like it should just be part of the plan, right? So if I'm like, I've got this idea, I'm like, I think my business is ready. I'm ready to do this. Then it's time to do the homework, right? Like, oh, wait, let me talk to the banker. Let me talk to my accountant. Financially, am I in a good spot? Am I going to be able to access the right kind of funds to help me achieve what it is that I want to accomplish? And how much do I need? All of that stuff just needs to be part of the strategic plan. So
Exactly.
makes perfect sense. All right.
One more thing, Val. Please do not mix your personal and business debt. Do not use your personal credit for the business. Your CPA not going to like that. The bank also not going to like that. You have to keep both separate. It's very easier for the tax purposes and also not mixing the personal with the business. It's going to help with the growth of the business as well because everything is clean and it's separate. So I just want to make sure, Val, I added that as well.
Yes, and I'll add it on to that as well. So it happens all the time. It happens all the time. It hurts you on the personal side too, right? So what happens is that let's say you're holding some debt on a personal credit card, but it was really used for your business. Well, your debt to income ratio, right? So that can be impacted. Also, your credit usage, right? So if you think about one of the factors that goes into your credit score is how much of the credit that's available to you are you actually using? And if that number is really high, banks they don't like that. That makes them nervous. They're like, uh-oh, they're maxing out all that they can do. I've seen this happen, okay? I've seen it happen as a banker, and the customer's like, oh, wait, no, that was for my business. That's not really my personal debt. I'm like, I have no way to distinguish that. It's showing on a personal credit card, and so I can't take it out. It's part of your personal debt, and so it's going to go into that factor. So that could impact the rates that you get on the personal side too. So there's just many, many, many reasons to keep them separated. It's just going to make your life much better. Okay. Okay. Now I'm getting off the soapbox here. Okay. Another reason business owners are often looking for credit is to help with cash flow gaps.
Well, Manoush, about cash flow gaps, right? So Manoush brought up a really important point. Do not wait until you've run out of options to come to the bank. Plan ahead. It's much harder to secure funding when you're in a tight spot. The best time to explore capital is when your business is stable and growing and definitely not struggling. So that's when you'll have more options, you'll have better terms and stronger negotiating power. With that said, the most common credit option for cash flow gaps would be a business line of credit, right? It gives a client the flexibility to access funds they can draw as needed. So whether it's to cover payroll, manage inventory, or bridge the timing between receivables and expenses. It's especially helpful for seasonal businesses or those with uneven revenue cycles. The key benefit is that interest is only paid on what is used, and once it's repaid, the funds become available again, sort of like a credit card. With that said, if you have shorter term gaps, some clients also use business credit cards, but we always try to talk through the cost and the discipline required to manage those responsibly as well. So those are the options to kind of help you with the cash flow gaps.
Kind of in line with that, let's say, I'll go back to you, Manoush. Let's say I don't really have an immediate need. I'm not experiencing a cash flow gap. I don't necessarily have something on the horizon, but part of me just wants to kind of have a plan B just in case, just for financial emergencies, because they do happen. And we are in a weird economic environment. What are some options that you would have business owners think about?
Yeah. So again, it has to be the product and services match with the business needs. And the borrowing cost is always going to be important. So the lender always say there is no walking around money. That's mean I'm just not going to give you the money just in case. There is no such a thing just in case. So um, that part is important. And again, they have to match it. Is it short term or is it long term uh, debt? Is it okay? Do you need line of credit, or are you planning to purchase the equipment? So because for each one of those borrowing costs, it has a specific product set. For example, if you want to buy a real estate, that's mean, okay, you do have a purpose. That's what you need the money for. But when we talking about emergency, let's just define emergency. What does that mean? That's mean if you want to buy supplies and you might not just gonna have to receive the money from your customers, and there is a possibility your customer is not gonna pay you on time, you want to have some sort of a reserve. Okay, I get that. So the best solutions, like I can only speak for Wells Fargo product, so that's why I just want to make sure I'm very clear. I cannot speak for all the banks. If you're banking with any other banks, you have to go and ask them. So like right now, we do have a credit card product, 12 months, no interest. So it doesn't hurt to have that type of a product just for the emergency situations. If you end up with that, then you can actually use that card. But if you're going to come and ask me for line of credit, I'm going to say, okay, do you have any gap currently with your operating cycle? Do you have on the horizons to want to actually hire more people, or you want to add a products? I have to have some borrowing costs, be able to work on it and give you the money for line of credit as well. So make sure when you are going to ask for any type of those credit, be able to articulate at least your future plan. That also can be used for the borrowing cost, but there is no such a thing of walking around money. So in case, none of the lender gonna like that terms, and that's something is just gonna you need to have a good story. I'm not saying make up a story. I'm just saying be able to articulate your business vision and what you're trying to accomplish for the future of the business, so they can help you with the right product that can help with the growth of the business. The other thing is, Val talked about it, about the gap. A lot of times when people think about the gap between account payable and receivable or the operating cycle, the only product they think of is credit. This is not true. Credit is not the only vehicle to help with the cash flow. There are other products such as treasury management, merchant services, can also help with the cash flow. I give you an example. We had a customers came to us and asked for $300,000. When we take a look at the all 5 Cs, remember I went through it, we only were able to give that customers 200,000. However, when we take a look at the entire operating cycle with these customers and we actually look at their tax returns, the bankers will identify some of our treasury management services and the merchant services by collecting the payment faster, by also helping to the account to become more secure and efficient, was able to fill the other $100,000 gap. So it's not only credit is answering for the working capital or the cash flow gap. There are a combination of all of the product and services. And I feel that's the advantage of working with the banks, because the banks offer holistically all kind of a product and services, and they're not limited only to credit. Again, that good banker and the CPA can actually give you those advice and help you with that.
As Merchant services, you're, making music for my ears, Madouche, but she brings up a great point, right? So the operating cycle is inflows and outflows, and yes, credit can be a great way to bridge the gap, but to Madouche's point, maybe there's a way that you could delay paying things out. Is there a way that you can negotiate different terms, right? And then on the other side, can you get cash faster? Can you use Zelle for small business? That's free. Like, what options are out there to help you maximize the inflows and delay the outflows? Credit can help, but it's not the only answer. Maybe there are cheaper options out there. So I'm glad you brought that up, Anoush. I want to open it up to this group and see if there are specific areas that you had questions about, or anything that we can help demystify for you on the bank credit side. I'm just curious, what's on your mind?
So Val, we have a question in the chat.
Awesome.
All right. It says, this is from Kathy Durfee. She would like the speaker's perspective on this. During the Great Recession, I used a credit line I had secured earlier when I didn't need it. At the time, the bank wouldn't have approved a new credit, and that should have been a red flag. Just because I had access didn't mean it was wise to use it. Now I believe it's risky to get credit just in case, because it can tempt you to rely on it when you really should be reassessing instead. She would like your feedback on that.
Manoush?
Yeah, sure. Again, it depends on your situations and what you want to do with the money. So from my understanding, and please correct me if I'm wrong, you're saying you had access to line of credit, you never used it, but or if you used it, now you feel like your business is relying on the credit. Is that what you're saying? And that's something I just want to make sure I understood your question.
Yeah, I can clear it up.
Yeah.
So before the Great Recession, I think around 2001 or so, I got a line of credit because everyone said, get a line of credit when you can. So when you
Yeah.
can't get it, you can use it. Thought, okay. Actually, it took me a long time to agree. I'm like, oh, okay, that makes sense. I finally did it. And then the Great Recession hit, and we lost 70% of our business in like 3 months. And I had a lot of family working for me at that time. I'm like, well, it hit our company before our community, so I didn't know it was a recession. I just thought I was doing a crappy job and I could fix it. So I used that line of credit to make payroll until it ran out. By then, we were deep into the recession. I still had no significant income, still had to lay everybody off. But I had a lot more debt than I would have other. So the recovery took a lot longer. And those people I couldn't bring on as quickly as I might have because I had done the debt thing. So what struck me was, if the bank would not have lent me money at that point, why am I using credit? Because I'm using credit under, just from a business model perspective, my business model clearly doesn't justify it. Otherwise, the bank would lend it to me. So for me to get the credit when I can and then use it when I can't, I realized, well, that's nuts, because it's a red flag. If they won't lend me money, I probably shouldn't be spending that money. And I probably need to have the layoffs now, not after I've accrued a bunch of debt. So that's one person, one example, one perspective. And you guys live and work in this industry all the time. I'll just say one more closing thought. I know for myself that I'm not a machine. I'm just not. I'm not a machine. I'm a person that owns a small business, and I care for my customers and my employees. So I will not live in a 100% rational bubble that has no kind of empathy, or because people say, oh, well, just don't worry about layoffs. Well, I mean, if that's the criteria, then I know I can never have credit, because that I don't live in that universe. So, okay. So yes, please, I'd love your feedback and your thoughts.
Yeah, you brought up the good point. And again, when we say go borrow money when you don't need it, what I mean is when the business is healthy, which that's what you did. Your business was not struggling at that moment. And again, from what I heard from you, that really helped you to keep those employees, keep those people you care deeply about them. And it helped. Of course, you had some big debt because you were using the line, but at the same time, the incentive for you was to keep those people, some of them, not all. And you lost some of your customers. It took you some time to recover and be able to gain that back, changing. Remember, we said to pivot and change the business strategy, and those help. It's not about right or wrong way. So the other thing is I want to add is, like, I can't speak only for Wells Fargo. Like, for example, there are some certain line size that we do annual review. And this is going to give us opportunity to hear our customers' story, what's happening. And if they are actually use the line, then max it out, then we're going to help them. What is the best option for them at that moment? Because we want to make sure we're going to have the opportunity to work with our customers. If we need to convert that product to something else, if we need to work with our customers and make it right with them to make sure they can pay the payment. So we have that opportunity. We don't want a bank job. It's not only, okay, I'm going to give you the credit and I'm going to give you the highest interest rate as long as you pay me the minimum payment, I'm out, I'm done. That is not the relationship between the bank and the small business customers. Remember when I said you have to have a business banker? This is all about, and that's how we can add value, understanding, assessing the situations of the business. And unfortunately, we have to sometimes make tough decisions as a business owner. Either I'm shutting down my business entirely, or I have to cut off some of my expenses, or go through the layoff 3 or 4 people to be able to maintain and stay in the business. It's a hard decision, and I'm not envying anyone in that type of a situation, but it's a between, am I going to still keep my business door open, or I'm going to lay off a few people just to be able still stay in the business, and hopefully I can hire them back in the future soon. So again, it's very situational. That's what I love about small business customers, and love to be in that space, because every one of you has a unique story to share. How you started your business, what is your passion, and what is your vision to grow the business.
Can I also add something to that, Manoush? I think that was really great.
Love
But
yeah.
I would say, no problem. I would say a line of credit is a tool, but not a solution, right? And the difference is, if a business is relying on it to survive, that's a signal to maybe take a step back, dig deeper, maybe sit with the banker or an accountant to take a look at the full financials and the operation of your business. So, and I'm sure times at that time times were different, but that would be my biggest advice to all of you, is that it's a tool, not a solution. You use it to continue to run your business, but if you're relying on it to a point where it's almost a struggle, then there's probably room for us to reevaluate the business and see what can we do to support you in maybe other ways or other tools that we have. That would be my add-on to that.
All right, I think we have time for maybe one more question if anybody else has a question or situation. I see Dawn.
Hi, Manoush. Good to see you again.
Hi,
Yeah.
good to see you too.
I'm a CPA, and as a proud member of many bail teams, I think when I talk to clients, especially about a line of credit, you do need to get it when you don't need it, right? That's kind of, banking is part of being a business owner. Your relationship with your bank is ongoing. To answer the question about, well, it kind of allowed me to, I wound up with a lot of debt because I used it too much. Well, I think the line of credit is really about buying you time to make a good decision. Because when things kind of go south or something happens, you're in the moment and you're not always thinking clearly. You can be very reactive, and it might not be that is not the time to make a really, necessary decision for your company. The line of credit's going to buy you time. It doesn't mean delay the decision to the end of the line of credit. At the same time, you didn't know how long. We all didn't know how long the financial crisis would be, and whether was that a month, was that 2 years, we don't know. But it would have it's supposed to allow you time to get your advisors together to say, okay, we have short-term funding. What are the decisions we need to make, and let's make them clearly. We don't have to make them today. And that's, really what I think, when I think of a line of credit and I talk to clients about it, including in my own line of credit, that's what it's there for. If something happens unexpected, I'm going to have time to make the decision that a good, thoughtful decision with, people I trust. And that's what that's going to give me.
Awesome. Thanks for the ad. Appreciate having another member of the Vail team here. So thank you, Dawn. All right. We are getting close to the end of our time. It went by really fast for me. I think it probably did for you as well. I just want to open it up for Manoush and Louisa. Any one final last piece of advice?
Go ahead, Louisa.
So first of all, I want to thank all of you. I want to thank you all for joining today. I really enjoyed my time on this panel, but I'll leave you all with this. If there's one thing I want everyone to take away about capital access is funding isn't a one size fits all. And I think Manoush mentioned that quite a few times today on this call. The best source depends on the business stage, goals, and financial health. And our role here is to help our clients understand their options, weigh in the trade-offs and choose what supports long-term success. Access to capital is not just about money, it's about strategy. And we're here to help. Manoush, anything else?
Thank you. Well said. And again, don't forget your BFF, CPA, attorney, and your banker. Make sure you build a solid relationship partnership with all three of them because they want the best for you. And again, it depends on your business stage where you are. You're gonna have a different product needs and different maybe planning you need to have. But if you have a mindset of growing your business, you need to think outside the box and listen to your CPA and your banker to help you to get there. If any of you on this call are debt adverse and say, I don't want to borrow money at all, you're hurting your business unless you come with a lot of money and you can't fund it unlimited. That's totally different story. If you win a lotto and you just want to actually go through all of your lottery money, that's totally different story. But have that type, but be responsible. I'm not just saying just go borrow money and put yourself in a bad positions and not be able to repay the debt. That's why the CPA is there for. That's why Dawn is going to be there to help you and give you the advice when you are doing on the quarterly financial review with her or your bankers, either one of them. And don't forget, capital access is not the only solutions for helping with the financials gaps you have. You can have other products such as treasury management, merchant. Combination of all can help you to grow your business. And thank you for having us today.
Thanks so much, Manoush. I just wanted to take a moment to thank you for the time. We loved spending time with you as we always do. And thank you, Manoush and Louisa, for sharing your expertise. I will say if any of you have a desire to chat with any of us after, you can certainly do that. We're more than happy to talk to any of you. So Linda, I'll turn it back to you to close us out.
Excellent. Thank you so much. And I just want to say thank you, Wells Fargo, for your continued partnership and helping us keep things going with the circle and making sure that we have the right resources. I hope you all have a fantastic day and a terrific October, and we'll see you next time.